Did you know that one book written in 1949 has made more people wealthy than any other financial text in history? The Intelligent Investor by Benjamin Graham doesn't just teach you how to pick stocks, it completely rewires how you think about money and market psychology. Today, I'm breaking down the 10 most powerful principles from this legendary book that can transform your financial future, even if you've never invested a single dollar before. Let me start with something that might shock you. Most people think investing is about finding the next big winner, but Graham teaches us the exact opposite. The foundation of wealth building isn't about hitting home runs. It's about not striking out. This brings us to his first crucial principle: margin of safety. Think of margin of safety like buying $1 for 50 cents. When you purchase securities at a significant discount to what they're actually worth, you create a protective cushion. If the market crashes, or if you made an error in your analysis, that discount protects you from major losses. It's like wearing a seatbelt while driving. You hope you never need it, but you're grateful it's there when things go wrong. Here's where most investors get it backwards. They see market volatility as their enemy, but Graham teaches us to embrace it as our greatest ally. Market fluctuations aren't obstacles, they're opportunities. When prices drop during downturns, smart investors recognize these as shopping sales, not disasters. When prices soar beyond reasonable value, it's time to take profits, not chase momentum. This mindset shift requires understanding a fundamental distinction that separates successful long-term wealth builders from those who lose money consistently. There's a massive difference between investing and speculating. Investing focuses on the long-term value of assets based on their ability to generate income and grow over time. Speculating is essentially gambling on short-term price movements without regard to underlying value. One builds sustainable wealth, the other destroys it. Now let's talk about protection through diversification, but not the way most financial advisors explain it. Graham recommends spreading your investments across at least 10 to 30 different securities. But here's the key detail most people miss. Stick with adequately sized companies, preferably those with market capitalizations over $2 billion. These companies have proven their ability to weather economic storms and maintain operations during challenging periods. But diversification alone isn't enough. You need to focus on what actually matters, company fundamentals, rather than just stock price movements. This means analyzing earnings patterns, dividend payments, and realistic growth potential. Too many investors get hypnotized by charts and price action while ignoring the business underneath. Graham teaches us to think like business owners, not stock traders. Portfolio balance becomes crucial here. Maintaining a strategic allocation between stocks and bonds with regular rebalancing aligns your investments with your risk tolerance and long-term objectives. This isn't about perfect timing. It's about systematic discipline that removes emotion from your investment decisions. One aspect that modern investors often overlook is the power of dividend-paying stocks. These investments provide passive income generation and add stability to your portfolio. While growth stocks grab headlines, dividend payers offer something invaluable: regular cash flow that does not depend on market sentiment or timing your exits perfectly. Here's something that might surprise you about Graham's approach. Before you even think about investing, you need an emergency fund. This ensures liquidity and prevents you from being forced to sell investments during market downturns when prices are depressed. Having cash available transforms market crashes from disasters into opportunities. All of this leads to what Graham calls value investing philosophy. This means seeking securities that are trading below their intrinsic value through careful fundamental analysis. It's not about finding the most popular stocks or following market trends. It's about identifying quality assets that the market has temporarily mispriced. Perhaps most importantly, Graham emphasizes knowing your investor type. Are you a defensive investor who prefers passive, index-focused strategies? Or are you an enterprising investor willing to dedicate time to active research? Neither approach is superior, but choosing the wrong strategy for your personality and available time leads to poor results. The defensive investor focuses on broad market exposure through index funds and requires minimal time commitment while still achieving market returns. The enterprising investor actively researches individual securities and aims to outperform the market through superior analysis and patience. What makes Graham's principles timeless is their foundation in human psychology rather than market mechanics. fear and greed drive most investment decisions, leading to buying high during euphoria and selling low during panic. Graham's framework provides emotional protection by creating systematic rules that override these destructive impulses. These 10 principles aren't just investment strategies, they're a complete philosophy for building lasting wealth. Start with margin of safety, embrace volatility as opportunity, distinguish investing from speculation, diversify intelligently, analyze fundamentals, maintain balance, prioritize dividends, build emergency funds, adopt value investing, and know yourself as an investor. The market will continue changing, new technologies will emerge, and economic cycles will repeat. But these principles remain constant because they're based on timeless truths about value, patience, and human nature. Your financial future depends not on predicting tomorrow's winners, but on following these proven principles consistently over time.